Warren Buffett's investment strategies prioritize long-term stability, quality investments, and informed decision-making. By focusing on market readiness and proactive planning, he builds resilient portfolios that withstand market fluctuations and yield sustainable financial returns. Market preparation. Warren Buffett's advice on market readiness is like preparing for unexpected weather. He suggests that rather than scrambling for an umbrella in the pouring rain, it's smarter to carry it with you just in case. In the same way, being prepared for a stock market crash is about expecting the unexpected and having a plan in place. Buffett's wisdom highlights the necessity of anticipating market downturns before they happen, rather than trying to navigate through the storm once it's in full swing. Buffett's philosophy is rooted in the idea that predicting the exact timing of market crashes is akin to forecasting the exact minute a thunderstorm will hit. It's almost impossible. Market crashes can be triggered by various complex factors, making their timing incredibly challenging to foresee accurately. Thus, Buffett advocates for a proactive approach, encouraging investors to always be on the lookout and ready to face potential market turmoil with a steady and composed mindset. The principle aligns with the value of long-term planning and stability. Buffett emphasizes the importance of maintaining a calm and strategic investment approach, even in the face of market turbulence. His philosophy encourages investors to focus on building a resilient portfolio that can withstand fluctuation and uncertainties. By adhering to a steady long-term strategy, investors can navigate market downturn more effectively and potentially emerge stronger once the storm has passed. This proactive and prepared stance can help mitigate risks and protect investments, ensuring a smoother journey through the unpredictable landscape of the stock market. Time in the market versus timing the market. Buffett's advice about staying invested in the market for a long haul instead of trying to predict when to enter or exit reflects his belief in the significance of patience and perseverance. He emphasizes that it's nearly impossible to accurately foresee the precise timing of market crashes or recoveries due to the intricate and ever-changing nature of market trends. This notion is akin to acknowledging that trying to time the market is like attempting to catch a slippery fish with bare hands. It's just too challenging and unpredictable. The billionaire investor urges individuals to adopt a steady and enduring investment strategy that considers the broader trajectory of the market. Instead of fixating on short-term market fluctuations, he advocates for focus on the long-term growth potential of investments. By encouraging a patient and consistent investment approach, Buffett aims to alleviate the anxiety and stress associated with trying to predict the unpredictable. His advice serves as a reminder that successful investing is more about staying committed to the sound investment strategy rather than making impulsive decisions based on short-term market movements. In embracing this philosophy, investors can build a resilient portfolio that can withstand the ups and downs in the market, ultimately leading to more stable and sustainable long-term returns. Market index funds. Warren Buffett's endorsement of market index funds, exemplified by his mention of the Vanguard Total Stock Market ETF, underscores his trust in the U.S. stock market's overall performance. By investing in these index funds consistently over an extended period, individuals can benefit from the market's long-term growth and stability. Buffett's approach highlights that the value of the diversified investment strategy, minimizing the risks associated with individual stock selection and market timing. Vanguard Total Stock Market ETF VTI is a prime example of an index fund that mirrors the performance of the entire U.S. stock market. This approach allows investors to participate in the growth and progress of a broad range of companies across various sectors. Buffett's preference for index funds reflects his belief in the resilience of the market as a whole, promoting a long-term investment strategy that aligns with the market's overall trajectory. One of the key advantages of investing in market index funds is the reduced exposure to individual stock risk. Rather than relying on the performance of a specific company, investors can benefit from the collective growth of multiple companies represented in the index. This diversified approach helps mitigate the impact of any potential underperformance of setbacks or individual stocks, providing a more stable and consistent return over time. Furthermore, investing consistently in market index funds aligns with Buffett's principles of staying in the market for the long haul. By avoiding attempts to time the market or select specific stocks, individuals can focus on the broader trends and growth patterns of the market, aligning their investments with the overall progress of the economy. Investing during a crash. Buffett's endorsement of the dollar-cost averaging strategy underscores the importance of maintaining a steady investment approach even during market downturns. The concept involves investing a fixed amount of money at regular intervals, regardless of the current market condition. This method serves as a practical tool to mitigate the emotional impact of market crashes, fostering a disciplined and systemic investment pattern that can withstand the volatility of the market. During periods of market decline, the dollar-cost averaging strategy proves particularly advantageous. By consistently investing during a downturn, individuals can take advantage of lower stock prices, effectively accumulating more shares at reduced cost. This process positions investors to capitalize on the opportunity for substantial gains when the market inevitably rebounds. Through the systematic purchase of shares at varying prices, investors can achieve a balance that cushions the impact of market fluctuations and promotes a more stable investment experience. One of the notable benefits of dollar-cost averaging is the ability to reduce the risks associated with attempting to time the market. Rather than trying to predict market highs and lows, this strategy encourages investors to focus on the long-term benefits of consistently investing over time. By adhering to the regular investment schedule, individuals can diversify their holdings and minimize the impact of short-term market volatility on their overall portfolio. In essence, Buffett's advocacy for the dollar-cost averaging reflects his belief in the value of maintaining a disciplined and consistent investment strategy. This approach not only helps investors navigate the uncertainties of the market, but also reinforces the idea that successful investing is a long-term endeavor. By adhering to the systematic investment plan, individuals can position themselves to capitalize on market opportunities and build a more resilient portfolio that can withstand the challenges of market fluctuation. Understanding investments. Buffett's advice about investing in what you know and understand makes a lot of sense. He suggests that we stick to the things we're familiar with and feel confident about, rather than venturing into unknown territories. This idea is like staying within a circle of things you're good at, which he calls the circle of competence. By following this philosophy, we can make smarter investment choices based on our knowledge and expertise. It's all about focusing on the long-term potential of investments that we truly understand, ensuring that we're well prepared to handle any challenges or changes in the market. This approach can help us feel more secure and confident in our investment decisions, which is crucial for long-term success. Quality of investments. Buffett's investment strategy revolves around selecting top-notch companies with robust market positions and a history of sustained success. These companies typically possess a sustainable competitive advantage, often referred to as the economic moat, which shields them from competitive pressures and market fluctuations. By concentrating on businesses with a strong track record or generating high returns on capital, investors can secure their portfolios against the impacts of market downturns. Buffett's emphasis on companies with solid foundations underscores the importance of long-term stability and growth, enabling investors to capitalize on consistent performance and enduring profitability. Avoiding debt and margin loans. Buffett's stance against using debt or margin loans for stock investments stems from risks associated with leveraging. During economic downturns and market crashes, companies burdened with significant debt faces heightened vulnerability, leading to substantial losses. By adhering to the conservative investment approach and refraining from excessive borrowing, individuals can protect their portfolios from potential risks, ensuring a more stable financial standing during periods of market volatility. Buffett's advice underscores the importance of maintaining a cautious and sustainable financial strategy, focusing on long-term stability rather than short-term gains that could potentially result in significant setbacks. Seeking alpha resource. Seeking Alpha is highlighted as a valuable resource for investors, offering a wealth of expert analysis, news, and educational content to improve investment strategies. The platform provides a one-stop destination for accessing a diverse range of information, including in-depth company analysis, up-to-date market trends, and various educational resources. By leveraging Seeking Alpha extensive resources, investors can gain valuable insights and diverse perspectives that empower them to make well-informed decisions. The platform's commitment to delivering timely and relevant information equips investors with the necessary tool to stay updated on the latest market developments and adjust their investment strategies accordingly. Warren Buffett's investment principles emphasize the importance of proactive preparedness, long-term stability, and informed decision-making. Avoiding excessive debt and leveraging Seeking Alpha's valuable resources further contribute to well-rounded investment strategy, enabling individuals to make informed decisions and achieve long-term financial success. For more such videos, like, share, and subscribe to the channel. Until next time, see ya!